What is synergy? Synergy refers to the expected cost savings, growth opportunities, and other financial benefits that occur as a result of the combination of two companies. Typically, strategic partners realize these synergies, but financial sponsors with a similar company in its portfolio could also benefit from cost or revenue synergies. And to quickly define, strategic partners are companies that operate in the same or similar industry that offer the same or similar good or service, whereas financial sponsors are private equity firms, hedge funds. They are pools of money that are invested and they hold different equity investments in their portfolio companies. Now, it's more common for strategic partners to realize these synergies, but financial sponsors, if they hold a similar company and their operations overlap, then there is also potential for synergies in those transactions as well. Now, there are 5 core sources of synergy. They are increases in revenues, decrease in operating costs, the decrease in taxes paid, a decrease in working capital requirements, and a decrease in required capital expenditures. And I'll go through these a little later in the video, but these are the 5 core sources of synergy. You need to remember these. So, which type of synergy is easiest to realize, and which one is the hardest? Now, cost synergies are easier, and this means less speculative, to realize because repeated functions within merging firms are realistic examples of cost savings. In addition, economies of scale are proven to impact costs, especially in horizontal acquisitions. Now, revenue synergies are much more speculative. While projecting potential growth in sales due to a new product or market seems logical, the probability of additional sales growth is much lower. And I don't want to spend too much time, but with cost synergies, the easiest example is that when these two standalone entities merge, you have 2 HR departments, 2 technology departments, 2 research and development departments. There are a lot of opportunities there to downsize, to cut jobs, to cut funding to different departments and save on costs. So from a cost perspective, it's much easier to understand where operations will overlap, especially if you conducted extensive due diligence. With revenue synergies, the problem is, how do you project future competitiveness, right? When it comes to revenue synergies, the whole goal is to become more competitive at post-transaction and therefore take advantage of that market share or that ability to perform in new markets and therefore realize revenue. The problem is it's really difficult to foresee that, and that's why majority of the models don't even account for revenue synergies. They assume it's zero, and the upside is therefore if it does turn out well, then the transaction is successful. But in most cases, analysts only account for cost synergies. Now, what are some examples of cost and revenue synergies? So for revenue synergies, which are harder to realize and therefore usually not included in projections, there are 2 common examples. One, the merged entity, has the ability to sell existing products or services in new distribution channels. So think of the acquirer and the target. So the acquirer operates in Canada and the target operates in the United States. Well, if I acquired that new distribution channel, the ability to work in the United States, I can now sell my product and service in the United States. The reverse is that I now have the ability to sell a new product or service in which I acquired, right, into my existing distribution channel. So say for that example, not only can I sell in the United States, but they also sell another service or product that I don't offer. Now I can offer that product in the Canadian market. The problem is, and you have to really be attentive to this, is sales cannibalization. So in a scenario where you operate in the same markets, well, the moment that you merge into one, people usually want to kind of diversify their purchases from different suppliers. So especially in the industrial sector, well, if now these 2 companies are one, I'm going to have to look for someone else to really buy from. And therefore, you'll actually lose sales and not gain sales. So there's a lot of risks when it comes to revenue synergies. That's why we said it's more speculative. Now, for operating cost synergies, it depends on the type of transaction. For a horizontal acquisition, where a company acquires another company in a similar function of the supply chain, companies can eliminate redundancies and leverage existing infrastructure for better pricing. For vertical transactions, where you either move up or down on the supply chain, the cost savings are much harder to realize, as quality and efficiency are in focus rather than cost. Now, for working capital synergies, and I think I'm going to make a separate video on this, but this is important. The savings originate from the amount of liquidity a business needs versus the amount it actually has on hold. The goal is to lower the investment required for working capital requirements. So the working capital of a business is used to really fund the day-to-day operations. Now, it's important to have a perspective from a net working capital. So this is the formula that you use when you're calculating the free cash flow. But look at net working capital. So for current assets, you have accounts receivable, inventory, prepaid expenses, and other current assets. Now the moment current assets increase, that's tying up cash in the business that can't be paid out to shareholders. So that's a use of cash. When current liabilities increase, that defers the use of cash and therefore increases the amount of cash available to shareholders in the business right now. So in a scenario where you're acquiring a firm, you want to make sure that the amount of accounts receivable, the speed of those accounts receivable increases, right? So you don't have accounts receivable that last 50 days. So that day sales outstanding ratio, the DSO ratio, declines. Or inventory, you don't want to carry as much inventory anymore. Say for example, you merge with another company that has similar facilities and you choose to close down a factory. Automatically your new combined inventory would be less than what it would be on a standalone basis for the two entities. So there's a lot of opportunities when it comes to working capital synergies. Now for tax synergies, there are countless strategies. It's an entire industry to save on taxes, whether it involves utilizing the new tax shield of acquisition debt, moving headquarters from a higher corporate tax region to a lower one. Say, for example, I'm a Canadian company and I acquire an Irish-based company. So I move my headquarters to Ireland and there, the corporate tax rate is 0. Or acquiring operating loss carry forwards, which can be used in the future. So tax synergies remain one of the most sought after goals for M&A specialists. And usually the surface answer when you talk about synergies is revenue and cost. But the tax synergies, the working capital synergies, the R&D synergies, this all falls under cost synergies. So for capital expenditure synergies, the savings can be easily identified in the investments of each company. So consider two agricultural companies merging with their respective R&D departments, researching the same type of fertilizer. If we're we're both studying fertilizer X. Well, now we're working towards the same goal. Do we need all of these professionals? We can probably downsize our research department. Do we need double the funding even though we were achieving the same things before as a standalone entity? Probably not. So you can actually not only acquire technology, but also cut down on R&D for the separate entity, right? Versus the combined entity. Other than that, that's pretty much it. Good luck, guys, with your interviews. Thank you.